Richard was 54 years old, and he had done everything right. He had spent 3 decades trying to double his money the way everyone told him to. He read the right books. He followed the conventional advice on how to double your money responsibly. 30 years of disciplined saving. Never missed a contribution. Never touched the money in a downturn. Worked with a respected wealth management firm. By 2006, he had accumulated $1.8 million. He was planning to retire early. His wife had picked out a house in Florida. They had booked a Mediterranean cruise. Then 2008 arrived. His portfolio dropped by more than half in 18 months. His advisor told him not to panic. It will come back. And technically, it did by 2013. But Richard was 61 by then, $800,000 short of his retirement goal. The Florida house never happened. The cruise never happened. He pushed retirement to 65, then 67, then 70. He didn't fail because he took reckless risks. He didn't fail because he made one catastrophic mistake. Richard failed because for 30 years he thought he was doubling his money, when the entire time he was doing it completely wrong. And nobody told him the difference until it was far too late. That difference is what this video is about. How to double your money. Not on paper, not nominally, but in real terms that actually change your life, because right now there is a very good chance you are making the same mistake Richard made. And the reason it's so hard to catch is that the wrong way to double your money feels exactly like the right way. The numbers go up, the charts trend upward, the account statements look healthy, and beneath all of it, something is quietly going wrong. Here is the core of the problem. When most people talk about doubling the money, they're looking at one number, the balance in their account. That number goes up, they feel like they're building wealth. But that number is a lie, not intentionally, not maliciously, but structurally, because there are two completely different versions of what that number actually means. There is the nominal version, the raw digits on your statement, and there is the real version, what those digits can actually buy you in the physical world. And for most people, these two numbers are moving in opposite directions without them ever noticing. Think about it this way. Imagine you've been going to the same coffee shop every morning for 10 years. In year one, your coffee cost $2. Today, it costs $4.50. Has your experience of coffee doubled in value? No, the coffee is exactly the same. What changed is how many dollars it takes to buy it. Now apply that same logic to your savings account paying 1% interest annually. Your balance goes up. But if the actual cost of living, groceries, rent, energy, healthcare is rising faster than that 1%, then every single year your money buys less. Your account grows. Your wealth shrinks. You think you're winning. You're losing. This is what inflation does in its quietest, most dangerous form. Not the dramatic headline inflation that everyone panics about, the slow, invisible kind that compounds against you for a decade before you feel it. Ray Dalio, who spent 50 years studying how wealth is built and destroyed across 5 centuries of economic history, has described this gap between nominal and real returns as the most consistently overlooked force in personal finance. The people who understand it end up on one side of every major wealth transfer in history. The people who don't understand it end up on the other side, wondering what happened. So the first question anyone serious about learning how to double their money needs to answer is not, what am I earning? The question is, what am I earning after inflation, after fees, after taxes? The real number, not the comfortable number. Most people who get this question right for the first time realize they have never actually known the answer. They knew their nominal return. They did not know their real one. And that gap between the two is precisely where wealth goes to disappear quietly over time. And here is where something genuinely useful comes in. A tool so simple it takes about 5 seconds to use, and so revealing that most people who apply it to their own situation are immediately uncomfortable with what they find. It has been around for decades. Bankers used it before calculators existed. It is called the Rule of 72. And once you understand it, you will never look at an interest rate or investment return the same way again. Here is how it works. Take the number 72. Divide it by your annual rate of return. The result is roughly how many years it takes for your money to double. That is the whole rule. No formula, no spreadsheet, just one division. If your investments grow at 6% per year, 72 divided by 6 gives you 12 years to double. At 10%, about 7 years. At 3%, 24 years. And at 1%, which is what most savings accounts pay, 72 years. Almost a lifetime. For a single doubling, now apply the real version of this. If your investments return 6%, but inflation is running at 4% in your actual life, your real return is 2%. 72 divided by 2. 36 years to double your real wealth. Someone in their 30s doing everything the financial system tells them to do could end up working until they are 68 just to reach a single doubling of what they have today. That is not a retirement plan. That is a treadmill. Here is what makes the rule of 72 so powerful as a diagnostic tool. It makes the invisible visible. It turns a vague sense of something is off into a precise, measurable number. So do this right now while this is still fresh. Think about the real return on your current money, and not the headline number, the real one after inflation and fees, and divide it into 72. Write that number down somewhere, because everything that follows in this video connects directly to whether that number is acceptable or whether it needs to change. And if you want to share what you found in the comments, do it. It is genuinely interesting to see how different that number is for different people. Now, here is the piece that most conversations about doubling money never reach, because it requires going one level deeper than just the rate of return. And this is the part that changes how you think about time. Most people assume that if they want to double their money faster, they need to find investments with higher returns. And yes, return matters, but there is something that matters more, something that even outperforms a higher return in the long run. It is the number of complete doubling cycles you get within your investing lifetime. Think of it like a snowball rolling downhill. In the first few seconds, it picks up a little snow, barely noticeable. A few more seconds and it is slightly bigger. Then something shifts. The snowball is now large enough that each rotation picks up dramatically more snow than the last one did. The same rotation that added a handful of snow at the beginning now adds an armful. The same rotation, just a larger base. This is exactly how doubling cycles work. The first doubling takes the most time and produces the least raw growth. The second doubling produces twice as much. The third produces twice as much again. And by the time you are deep into the cycle, each doubling adds more absolute value than all the previous ones combined. This is why two people both trying to double their money can end up in completely different places. Not because one was smarter or luckier, but because one had more complete doubling cycles than the other. Consider two investors. One starts at 25 with modest contributions earning 10% annually. The other starts at 35 with larger contributions earning 15%. You might expect the higher return to win. It doesn't. The earlier start gives the first investor more full doubling cycles, and each additional cycle multiplies everything that came before it by 2. Not adds, multiplies. The math is relentless about this. Time does not add to compounding. Time multiplies it. The implication of this is uncomfortable but important. Every year you delay starting is not 1 year of growth lost. It is a potential doubling cycle lost. And that lost cycle would have multiplied every single dollar that came after it. This is why Dalio's research consistently points to early positioning, not just starting early in life, but getting correctly positioned before cycles turn as the single highest leverage decision in wealth building. Now, there's a twist here that almost nobody talks about, and this might be the most counterintuitive thing in this entire video. When people decide they want to double their money faster, the instinct is always to earn more, find a higher returning investment, take on more risk, chase better performance. But the data consistently shows that for most people, the fastest path to a shorter doubling time is not earning more. It is losing less. Here is why. Fees, taxes, and unnecessary costs do not just reduce your returns. They compound against you at the exact same rate they would compound for you if they stayed in your account. A single percentage point in annual fee sounds almost invisible. 1%, who notices? But run it through the rule of 72 in reverse, and that 1% is doubling the amount you're losing every 72 years. Over 30 years, a fee that seems negligible can silently devour a third of your final balance, not by taking a lump sum, but by removing small amounts continuously and denying those amounts their own future doublings. Every dollar that leaves your account as a fee is not just $1 lost. It is every dollar that dollar would have become over the remaining years of your investing life. High interest debt operates the same way, but far more aggressively. A credit card charging 20% interest is doubling what you owe every 3.5 years. If you carry that while your investments are compounding at 8% for you, you are running a race where the finish line is moving away from you faster than you can run toward it. The fees win. The debt wins. Your doubling time gets longer every year. Reducing that friction, not chasing higher returns, is often the single fastest way to shorten your doubling cycle. There is a simple exercise that reveals this immediately. Take your current annual fee percentage across all your accounts, divide it into 72. That is how many years it takes for your fees to cost you one full doubling. For most people with typical managed fund fees, that number comes out somewhere between 15 and 25 years, meaning across a 30-year investing period, fees alone will cost you at least one complete doubling. One full multiplication by two, gone silently year after year without a single bad investment decision. This is one of the core principles that Ray Dalio rebuilt his entire approach around after his 1982 collapse. In that year, he publicly predicted a depression that never came. He was certain. He had studied the data. He went on television and told his clients. He was completely wrong. The market went up. The economy boomed. His clients left. His reputation was destroyed. He had to borrow money from his own father just to keep his family fed. And in the years that followed, years of studying what had actually happened, what he had missed, what the historical record really showed, he came to understand something that became the foundation of everything he built afterward. The people who consistently doubled their wealth across every economic environment in the last 500 years were not the people who made the best predictions. They were the people who built systems around the real numbers, who measured the right things, who understood the difference between what their money appeared to be doing and what it was actually doing in purchasing power terms, and who adjusted their positioning based on where the long-term cycle actually was, not where the short-term headlines suggested. Which brings us to the most specific and most urgent piece of this conversation, because the current economic environment is not neutral. Based on Dalio's framework for long-term debt cycles, the conditions that are building right now create a very specific challenge for anyone trying to double their money using conventional strategies. Total debt in the economy has reached levels that historically precede major deleveraging events. Government interest payments have exceeded defense spending for the first time in modern history. These are the conditions under which the assets that worked reliably during the growth phase begin to underperform in real terms, even as they appear to grow nominally. In the 1970s, someone holding a broad stock portfolio from the late 60s to the early 80s earned essentially zero real returns over more than a decade. Their balance fluctuated. But after accounting for inflation running at 7 to 9% annually, their actual purchasing power had barely moved. 14 years, one of the longest doubling cycles in modern financial history, not because the market was broken, but because the economic environment had shifted in a way that made conventional positioning the wrong positioning, and this was not an unusual or unrepeatable event. The same pattern appears in the historical record again and again. Every time a long-term debt cycle reaches its resolution phase, the conventional assets of the preceding growth period underperform in real terms while appearing to grow nominally. The people who understood this in advance, who had studied the cycle rather than just the recent trend, were the ones who doubled their money during those periods. The ones who didn't understand it were the ones who woke up a decade later wondering why their real wealth had barely moved. The assets that actually doubled wealth during those periods had three specific characteristics. They generated real income that continued regardless of what currency was doing. They had genuine pricing power, the ability to raise what they charged faster than their own costs rose. And they were grounded in something tangible that could not be printed in the worthlessness. These are not exotic or complicated assets, but they are different from what dominates most people's portfolios today. And the alignment of a portfolio with the actual economic environment rather than the ideal theoretical one is what Dalio has consistently identified as the difference between the people who preserved wealth through every major disruption in history and the ones who didn't. So what does all of this mean in practice? What does someone actually do to double their money correctly, starting this week using what we have covered? The first step is to calculate the real number. Take every significant account you hold. Find the realistic long-term annual return, not the best year, the consistent average. Subtract the real inflation rate you personally experience. Divide 72 by what remains. That is your real doubling time for that asset. Write it down. If it is acceptable for your timeline, leave it. If it is not, you now know exactly where the problem is. The second step is to audit the friction. Look at P's across all your accounts. Look at any high-interest debt. Quantify what these are costing your doubling time using the same rule of 72 logic. For most people, addressing the friction alone shortens their doubling time by 2 to 4 years without touching a single investment. That is 2 to 4 years of compounding cycles recovered at no additional risk. The third step is to ask honestly whether your current asset mix is designed for the economic environment that is actually coming, not the one that existed when your strategy was set up. This is not about abandoning diversification. It is about ensuring that a meaningful portion of your portfolio is in assets with genuine pricing power and real income generation, the kind that have historically preserved and doubled wealth even when monetary conditions were working against paper returns. The fourth step is the one that sounds the simplest and turns out to be the hardest. Stay in. This is the step that separates the people who actually double their money from the people who come close and then break the cycle at exactly the wrong moment. Do not interrupt the compounding cycle because of fear or uncertainty or bad news. The investors who doubled their wealth through 2008 were not the ones who made a brilliant call at the bottom. They were the ones who were correctly positioned before it happened, stayed there through the worst of it, and collected the full doubling cycle on the other side. Breaking the cycle, even once at the wrong moment, does not just cost you a year. It costs you every doubling that would have followed from that moment. Go back to Richard for a second, not to feel sorry for him, but to understand precisely what went wrong. He did not need a better stock tip. He did not need a better stock tip. He did not need a different advisor. He needed one thing, the real number. His actual doubling time measured correctly in the actual economic environment he was operating in. If he had calculated that number in 2005, he would have seen immediately that his positioning was wrong for what was coming. He would have had time to adjust. The Florida house might have happened. The cruise might have happened. The 30 years of discipline might have paid off the way it was supposed to. He never got that number. Now you have the tool to calculate yours. The rule of 72. The difference between nominal and real returns. The compounding cost of fees and friction. The importance of asset alignment to the actual economic environment. The irreversible value of full doubling cycles. This is how money actually doubles. Not by finding a secret investment. Not by timing the market perfectly. By understanding the real numbers, removing what is working against you, and giving the mathematics of compounding enough time and space to do what it is designed to do. Richard spent 30 years thinking he understood his number. He thought he knew how to double his money. He had the account statements to prove it. What he didn't have was the real number, the actual doubling time after inflation, after fees, in the specific economic environment that was building around his portfolio without his knowledge. Now you have the tools to calculate yours. The rule of 72, the distinction between nominal and real, the compounding drag of friction, the irreplaceable value of full doubling cycles, the importance of positioning for the actual environment. How to double your money is not a secret. It is arithmetic. And the arithmetic is available to anyone willing to do it honestly. Richard didn't. Now you can.